Hello, and welcome to our bi-weekly Understanding Markets video update. We are recording this on the afternoon of Tuesday, the 14th of June. I'm Hellen Dalton, a Senior Investment Manager here at Cantor Fitzgerald, and I'm once again joined by our eminent Chief Investment Officer, David. Hello, David.
Hello, Helen.
So, David, I believe we heard from the ECB last week, and Christine Lagarde had a very clear message this time around for markets.
She did indeed, Helen, and good afternoon to everyone watching this. Since we did our last video about 2 weeks ago, we've seen a significant amount of market volatility and really driven by central banks. And as you alluded to there, primarily, but not exclusively, down to the ECB. Last Thursday at the ECB policy meeting, we got the biggest indication from, or the clearest indication from the ECB about their intended path of interest rates. I think if you remember the last time we've been speaking about the ECB, the message from the likes of Christine Lagarde, the ECB president, Philip Lane, the chief economist, and a number of other more dovish council members had been saying that inflation was transitory, despite the fact that it had picked up. They were continuing on this temporary inflation concept, but they have eventually, I suppose, thrown in the towel on that and have now given signals to the market that they intend to increase interest rates by 25 basis points at their meeting at the end of July. They've announced, and this was expected by the markets, that they were going to stop their quantitative easing or asset purchase program at the end of June. So they gave a clear indication that they will increase rates at the end of July by 25 basis points, but equally well, they also indicated that at the next policy meeting in September, they may very well increase rates by more than 25 basis points. So in other words, 50 basis points. So that took markets very much by surprise. I think the markets had been pricing in maybe 25 basis point rate increases at the July and September meetings. But clearly the internal conversations between the council members has been driven very much by the hawks, or those policymakers from the likes of the Dutch and the German central banks, who really want to see a more aggressive pace of tightening by the ECB. And it was the clearest communique that Christine Lagarde has given. Her previous press conferences have been somewhat confusing in the messaging, but this one was crystal clear that they are going to aggressively hike rates. And as a result, equity markets came under pressure. Bond yields increased significantly. Just to give viewers an idea, back on the 31st of May, when we did the last recording, the German 10-year bond yield was at about 1.04%. It's now trading at 1.67%. So we've seen a really significant pickup in rate expectations for the Eurozone.
And in terms of inflation, because of course that's the another thing that grabs the headlines, it clearly spooked markets when we got the ECB inflation figures. Did you see any silver lining in the numbers?
Well, I suppose the ECB forecasts in relation to inflation were probably not wholly unexpected. I think the main figure that kind of gave the market somewhat of a spook following the ECB meeting last Thursday was the US CPI data on Friday, which came in at a 40-year high at 8.6% on the headline number. That was ahead of the 8.3% that was expected. As regards a silver lining within the data, I think the one silver lining, and albeit it's a modicum of a silver lining, was that the core inflation number in the US actually came in pretty much in line with expectations. When you strip out food and energy, it was up about 6%, still very elevated, but that was down from 6.2% in the previous month's reading. So some signs of a bit of moderation on the core number. And that tallies and fits in with some other reasonably positive inflation-linked data that we've seen over the course number of weeks from the US. Average hourly earnings in the non-farm payroll data the Friday before came in no worse than expected. In fact, it moderated marginally. And equally, the core PCE number, which is the Fed's preferred reading of inflation about 2 weeks ago, that also came in slightly lower than expected. So not saying that we've reached a peak in inflation, because clearly the two main drivers of inflation at the moment are fuel and agricultural commodities feeding into the food complex. So they're persistent there. But when the ECB and the US Federal Reserve strip out those numbers, inflation elsewhere in the economy isn't quite as hot as maybe the numbers suggest.
And what about the US? The figures came out there just before we started this recording. I know you haven't had a chance to look at it in depth, but what's the gut feeling there?
Yes, we had producer price index numbers out of the US at 1/2, and they came in again a little bit better than expected. The headline figure came in at 10.8%. Still significant, but that's down from 11% last month. And again, if you strip out the key food and energy components, the increase was annualized 8.3%, and that was below the forecast for 8.6%. So what that figure does now is put the focus, which is where the big focus is this week, on the US Federal Reserve tomorrow. US Federal Reserve have started their 2-day deliberation ahead of their policy announcement tomorrow. And I think what caused the markets to sell off so aggressively in the last 48 hours was that headline inflation number in the US on Friday. The market pricing for the Fed had been a 50 basis point rate increase at this meeting tomorrow, and also in their July meeting. Markets are now suggesting that the Fed may even move as high as 75 basis points tomorrow, which isn't something that's been priced in, and that probably spooked the market somewhat in the last 24, 48 hours since that inflation reading. So certainly we've seen a little bit of stability today in equity markets after the sell-offs yesterday and Friday. And I think the markets generally are on tenterhooks as to what message the Fed do deliver tomorrow. I think the critical thing for the Fed tomorrow is if they do move by 75 basis points, or indeed if they really go aggressive and increase by a full 1%, if they give a signal that they're moving the rate of interest rate increases up sooner, and that they're going to not be as aggressive going forward, I think that ultimately would be constructive for the markets. The markets would take the view that they're taking decisive action to help curb inflation. But if they go aggressive at 75 basis points and say that they could possibly do that at the next number of meetings, then I think you're going to see continued market volatility. So it's very much up in the air, and it's going to be very much how the Federal Reserve Committee communicate their message tomorrow.
Yeah, indeed. And it's just another example of markets just cannot stomach the unknown. It's the unexpected that really tends to spook it. And on that front, I'm seeing just growing noise about that dirty word, recession. Is there a chance we're talking ourselves into a recession?
There is an element of that, yes. I think that, as you're correct, the talk of recession has grown louder and louder over the course of the last number of weeks, particularly when you see such hawkish comments coming out from central banks. And the foundation for the recession talk is really predicated on the belief in some areas of the market that the underlying economy, which is actually tipping along reasonably well, given all that's happened on the geopolitical front and the higher input costs, we're starting to see supply chains reopen, that the fear amongst a number of and a lot of market observers would be that if the Federal Reserve and the ECB move as aggressively as they indicate that they might, that they could very well choke off the latent recovery that's going on in the overall economy. And so I think that's where the recession fears come in. People are also looking at the bond market. We touched on this a number of videos ago about an inversion in the yield curve. That's happened again now. The yield curve has inverted in the US over the course of the last 24, 48 hours on the back of the inflation number. So that's adding to the focus of recessionary fears. Our own view, and our colleagues in MIM would be, we're of the view that a recession will be avoided. Certainly there will be an element of slowdown as interest rate increases feed through the system. But we don't believe at this point in time that we are going to see a major recession, or if there is a recession, it is certainly going to be a very shallow recession.
Okay, and thanks for covering that one. Something you and I on this video update have not spoken about before is crypto, mainly because it just doesn't form part of the well-diversified portfolio that you would be managing as the head of our discretionary department. But of course, it does cause an awful lot of ripples at this point. What are your takeaways at the moment?
Well, I think the focus on crypto in the last 24, 48 hours has been the excessive degree of sell-off that there has been in that space. And you're correct that cryptocurrencies do not form part of our diversified portfolios for various reasons, which I won't go into now. But essentially, what we've seen with crypto and Bitcoin, if you take Bitcoin as the flagship cryptocurrency, I suppose, that's down 70% now from its 52-week high. It was trading as high as $69,000 around about June last year. It's now about $22,000. And I think a lot of the money that was invested in crypto has been impacted by the move higher in rates, the move higher in yields, which increases the cost of funding leveraged positions. And there's no doubt that a lot of retail investors probably have borrowed to take their position in cryptocurrencies. And as the price of the asset falls, and as the funding costs of that leverage increase, they end up being squeezed and ultimately probably being forced seller of the asset, and indeed forced sellers of other assets as they try to raise money to pay the margin or the borrowing costs if they've taken it out against crypto. So there is this kind of snowball effect. I'm not saying that it's the main reason for what the volatility that we're seeing in markets at the moment. It's clearly it's central banks and the uncertainty there. But something like an asset class like crypto, which a lot of areas of the market, people in the market would have viewed as speculative, when that starts to unwind, it does have a knock-on effect. And you've seen it in some areas of the NASDAQ, in the particularly the retail stocks like the ARK Innovative ETF, which is back down to mid $30, Coinbase, GameStop, all of these stocks that were really in vogue with retail investors, all coming under pressure, and it seeped into the broader NASDAQ as well, as technology names are liquidated to fund crypto positions.
Yeah, it's one of it's where the fast money has gone into and come out of. I suppose as a final point, given your position as a head of discretionary portfolios, would you say you're a buyer or a seller at the moment?
Oh, on balance, I think what we've seen over the course of the last, well, if you just look at the figures year to date, NASDAQ is down 30%. S&P is now getting a lot of coverage in a bear market territory, so a decline of 20% from its most recent high. So it's down 21% year to date. Euro stocks in Europe is down 20%. There's a significant amount of bad news priced into markets at this point in time. Now, clearly, as I said, there is still uncertainty about the messaging from the central banks, particularly the Fed tomorrow. And I think that's going to be very critical for the short-term direction of markets. It could well be that they come out with a message that seems that might be a bit more hawkish than the market expects. Risk assets may come off a little bit further, but ultimately, once the projected paths of interest rates is clarified, risk assets should find a support and rebound. I think it's worth pointing out that Market valuations have come back quite a bit. The S&P 500 is now trading on a PE multiple of about 14.5 to 15. That's down from 22 times at the peak at the start of the year. The European markets are trading on PEs of about 12 times, which is quite a significant discount to historic averages. So there's a lot of bad news priced in there. On balance, to answer your question, I would be looking to try and deploy money on any signs of some sort of kind of bottoming process in the market. You'll never get the very bottom, but there are some really good quality names that we like. If you look closer to home, they're all on our analyst conviction list, the likes of CRH, Smurfit's, Ryanair. If you want to get broader exposure to the NASDAQ, something like the iShares NASDAQ 100 UCITS ETF. It's one we've had in our weekly trader a couple of times. It's a good broad-based way of getting exposure to a sector that has names that still have resolutely strong balance sheets and very strong business fundamentals.
Thank you, David. Very insightful as always. And if you have any questions, please do make sure you get in touch with your Cantor Fitzgerald broker. They would be very happy to help you. Now, Understanding Markets is taking a summer holiday, so we will be back with you again in 1 month. Many thanks.